Real thoughts, real trades, real journey. A video journal documenting the lessons learned on my journey to becoming a disciplined trader. Welcome to Trading the Journey. I'm Neil, and today I want to share a trade that taught me one important lesson. Let's see what the market had to teach me. So I actually want to go over a trade that I made yesterday during the market. It was a Monday, and we all hate Mondays. But that's if you have a day job. Haha. So my bias yesterday was bullish. There was a pullback overnight that had an upward grind. There was kind of a double top on an upward trend on all the charts, and it broke its structure. But I was still bullish, with maybe a pullback. I might see a little bit of a downtrend before it goes up. And it already started for 30 minutes with a double top, but it may not be exhausted yet. And that was mostly on the 15-minute time frame where it was very clean. It was definitely choppy price action overnight, on the downtrend, and it was just ugly on the way up as well. The 2 and the 5-minute charts started as a small downtrend, and I was just watching to see if the 15-minute can catch up and agree with it. Both sides of the... Now, what was interesting is that when I was drawing my opening range here, the both sides of the range were actually very close to we were actually very close to pre-market highs and lows. And so, which, in my opinion, was strong. But I was prepared to go either way. Sellers made some great moves. Buyers made some great moves. So it was a pretty good day. So when it broke to the upside, not too bad. Pretty clean as far as, very little wicks here and there. So it wasn't too bad. I was just waiting on the market to decide which direction it wanted to go in. And so I got in, and it was a little bit of a slippage, but I had my stop. My stop was actually confirmed by a good candle that broke back inside the fence, and then it just came back out. And when it broke over my 1-to-1 risk versus reward, I started trailing my stop up using my 9 simple moving average indicator. And I ended up getting stopped out, actually. Whether that was right or wrong, I could have trailed with the 20 SMA and gotten a little bit more. But I wanted to capture as much as I can and start working on trailing my stops to capture as much as I can in the event that it would just skyrocket, right? And I still had my profit target at 2-to-1. So the market ended up, it came back down just a little bit, and then it decided to go to the 2-to-1, my 2-to-1 risk versus reward before it had before it decided to have a major pullback, and then go really sideways. And there was a lot of opportunity here. I closed it down, simply because because of my rules. My rule was, if I didn't win the way I was supposed to, I would just simply close it down. And you can see that the market did a double bottom here, 1, 2, and it came up. But there was plenty of opportunities on both sides to take another trade. You had a power bar here. To me, that's one, because it does clear a swing and it's on a downtrend. But I just simply followed the rules and shut it down. So But the lesson here is managing the trade. I kind of feel like I mismanaged it to a degree, and it looks like, based on the price action, that the market was showing me how to manage the trade properly. I don't feel there was a mistake in the way I managed it, but I could have gotten a little bit more. I could have gotten a lot closer to one to one. So maybe that was the mistake then. Whenever it's a slow grind up, choosing the proper trail or the proper stops on a slow moving market, where there's not much the volatility was pretty good throughout the morning, going into the afternoon, so it wasn't too bad, but it wasn't crazy. So maybe using the slower moving average would have been a lot better for a slow moving market. And this is where trade management comes in. You want to be able to capture as much profits as you can when it's going in your favor. And so I definitely need to learn when and where to use my fast moving average versus my slow moving average. Because the whole point of this is making money. That's the whole point. And you can see on the chart that my slow moving average, if I had trailed my stop using my slow moving average, I would have gotten just a little bit more. Right? And then if it would have kept grinding up instead of pulling back below, then definitely a lot more, all the way up to my target. So the moving averages can help you manage the trade pretty well if you know when and where to use them. So, like, say if I would have gotten in probably here, then using the slow moving average would have been preferable on that. And then we have a divergence in the moving averages here. And in this instance, of course, the fast moving average would have made more. So it depends on how you want to manage your trade, when and where to use the moving averages to take profit. So thank you for joining me for today's lesson. The market has voted. Today's lesson is written. I hope something from today's trade helps you on your own journey towards becoming a more disciplined trader. If today's trade reminded you of something you've experienced yourself, please let me know in the comments. I'd love to hear your perspective and what you have to say. If you enjoyed today's journal entry, I'd really appreciate it if you like the video and subscribe to follow the journey. Until next time, real thoughts, real trades, real journey.